Imagine this. Your company needs a big new piece of equipment. And the first question is always, should we buy it or should we lease it? Well, the accounting for that decision can get complicated, and it can get complicated fast. So today, we're going to pull back the curtain on the two main paths of lease accounting so you can really understand what's going on with a company's balance sheet. So here's our game plan. First, we'll meet our two types of leases. Then, we'll run through the 5 key questions that tell them apart. We'll see how, kind of surprisingly, they both start out the same way before their paths split. After that, we'll get into the really crucial part, the impact on the bottom line. And we'll finish up with a handy shortcut for short-term leases. All right, let's kick off our tale of two leases. So when your company, the lessee, is using an asset, the accounting rules say you've got to classify that lease. And it falls into one of two buckets. It's either a finance lease or it's an operating lease. Okay, let's cut right to the chase here. The best way to think about this is with a simple analogy. A finance lease, that's basically like you're buying the asset and taking out a loan to do it. An operating lease, on the other hand, is exactly what it sounds like. It's just a simple rental agreement. Seriously, keeping this buying versus renting idea in your head is the key to understanding everything else. So, how do you actually decide if you're buying or renting in the eyes of the accountants? Well, it all boils down to 5 questions you have to ask right at the very beginning of the lease. And here's the kicker. If you get a yes to just one of these 5 questions, boom, it's a finance lease. Let's walk through them. First up, are you going to own the thing at the end? Pretty simple. Second, is there a bargain purchase option that you'd be kind of crazy not to use? Third, are you leasing it for most of its useful life? Fourth, do all your payments basically add up to what the asset is worth? And last one, is this thing so specialized that the owner couldn't really lease it to anyone else? If you answer yes to any of those, the deal looks a whole lot more like a purchase. So, it's a finance lease. Let's put a real number on that third question. The official guidance says that the major part of an asset's economic life is generally 75% or more. So, if you lease a machine that has a 10-year life for, say, 8 years, you've checked that box. And for that fourth question, the one about payments, the threshold for substantially all is usually 90%. This just means if the present value of all your lease payments, what all those future payments are worth in today's money, is at least 90% of the asset's sticker price, then yeah, it's treated like a purchase. So what happens if you go through all 5 of those questions and you get a no every single time? Well, only then, only when you've said no to all 5, does it get classified as an operating lease. That's our simple rental. Now, after doing all that work to classify the lease, you'd probably think the accounting would be totally different, right, from day one. But here's where things take a surprising turn and actually get a little bit easier. That's right. It doesn't matter if it's a finance lease or an operating lease. The very first entry you make in the books is exactly the same for both. It's a really nice simplification that puts both of these paths on the exact same starting line. Look, the actual math can get a little hairy, but the principle is really simple. On day 1, the company puts 2 things on its balance sheet: a right-of-use asset, which is just your right to use the equipment, and a lease liability, which is your promise to make the payments. The big takeaway here is that at the very start, the balance sheet looks identical for both lease types. Okay, so they start in the same place. But this is where the story splits in 2. After that first day, the way you account for the lease, especially the expenses, becomes very different depending on that classification we did earlier. For a finance lease, remember our purchase path, you're going to see 2 separate expenses. You've got interest expense on the liability, just like with any loan, and then you have amortization expense on the asset, which is basically the same thing as depreciation. For an operating lease, the rental path, it's way simpler. You just record one single steady lease expense every period. Now, if we dig just a little deeper into that finance lease, the amount of time you amortize the asset over actually depends on why it got classified that way. If it's because you're going to own it at the end, either through transfer or purchase option, you spread that cost over the asset's entire useful life. Otherwise, you just do it over the lease term. And here's something pretty fascinating about the operating lease. Even though you only see one line item on the income statement called lease expense, what's going on under the hood is that this number is actually made up of both the interest and the amortization. The accounting rules just combine them into one neat number for presentation. Okay, let's do a quick check-in on that initial recognition idea. At the very beginning of the lease, what should Unir company report? If you're thinking that both lease types start out the same way, you've got it. The answer is B, an asset and a liability. So why do we care about all this? Why does it matter? Well, this distinction between finance and operating leases has a huge impact on how a company's financial performance looks, especially when you start looking at the income statement and, most importantly, the statement of cash flows. This table right here is really the key takeaway of this whole thing. The biggest difference is on the statement of cash flows. With a finance lease, the payment gets split. The part that's principal is a financing activity, just like paying down a loan. But with an operating lease, the entire payment, all of it, is considered an operating cash outflow, and that is a huge deal. It can make a company's core business look more or less profitable, which is a metric that analysts watch like a hawk. Before we wrap this up, there's one last, really practical exception to all these rules that you absolutely need to know. It's a handy little shortcut for leases that are super short. So what is a short-term lease? It's pretty straightforward. The lease term is 12 months or less. The only little catch is that it can't have one of those bargain purchase options that you're almost guaranteed to use. So here's the deal. Companies can actually choose not to apply all these big lease accounting rules if it's a short-term lease. And if they make that choice, they don't have to put the asset or the liability on their balance sheet at all. They just record the payments as rent expense. It's basically a form of off-balance sheet financing, which definitely makes things simpler, but you could argue it also makes things a little less transparent. You know, when you really take a step back from the numbers, you start to see that this isn't just some accounting exercise. Whether a company's balance sheet is loaded up with finance leases or operating leases can actually tell you a lot about their long-term strategy for how they acquire and use their most important assets. So the next time you're looking at a company's financial statements and you see those lease disclosures, you can ask the real question. Are they just renting to get by? Or are they effectively buying these assets for the long haul? And now you know exactly how to figure out the answer.